Hey, welcome back to the show. So, we've got another earnings report to dive into, and this one's for Adani Ports and Special Economic Zone Ltd. It looks like they've been busy.
Right. And it's not just about port stuff this time. They're really trying to push the whole integrated transport utility angle, like making it a full supply chain service.
Oh, okay. So, for the uninitiated, can you give us the quick overview of what Adani Ports is all about? Like, what do they actually do?
Well, basically, they're a huge port developer and operator in India, but they're also moving into logistics. Think of it as not just moving ships in and out, but everything from getting the goods off the ship to the customer's door.
Got it. So they're not just about the ports themselves, but also the connections, the trucks, the warehouses, the whole nine yards. Kind of like a giant interconnected web, right?
Exactly. It's like trying to create a one-stop shop for all things transport and logistics. They've got 15 ports across India, plus some international ones, and they're aiming to handle huge amounts of cargo by 2030.
That's massive. So, what are some key takeaways from the financial report? Let's start with the income statement.
All right. So, for the 9 months ended December 31st, 2024, their revenue from operations grew by 14% year on year, reaching about 22,590 crore rupees, and EBITDA grew by 19%. Pretty solid performance.
Okay, 14% revenue growth and 19% EBITDA growth sounds like a pretty good quarter. What about the bottom line? How's their net profit looking?
Well, their profit after tax also jumped by 32% to reach 8,038 crore rupees, and their EBITDA margin improved to 62%. So they are seeing growth and also efficiency.
That's a pretty significant jump in profits. And it seems that efficiency gains are really boosting their numbers. That's good. Any details on their earnings per share?
Their basic and diluted earnings per share were 37.40 rupees, which is also up quite a bit compared to last year, which was 28.10 rupees. So things are looking quite healthy on the income statement.
Impressive. So, what about their balance sheet? Anything noteworthy there in terms of their assets, liabilities, and equity?
Okay, so the total assets are at 1,32,374.78 crore rupees. Now, the total liabilities are at about 70,562.06 crore rupees.
Okay, so that is about a 50% debt to asset ratio. That's not bad for a company in the infrastructure sector. I mean, they've got a lot of heavy assets. What about their debt to equity ratio?
The debt to equity ratio is 0.77, which is a bit lower than 0.92 from last year. So they've managed to reduce their relative debt levels, which is good from a solvency perspective.
That's definitely a good trend. Lower leverage is always a sign of good financial health. So that's a good check mark. What about their cash flow?
The cash flow statement isn't fully detailed here, but they do mention having a net debt to TTM EBITDA at 2.1x, which is actually down from 2.3x in FY24. It implies that they are generating sufficient cash flow to cover their debt.
That's a good indication that they are indeed managing their finances quite well. So they're earning more, reducing debt. Sounds like a healthy balance. Let's talk about some key financial ratios. What's stood out to you?
Well, their debt service coverage ratio is 2.18, which is pretty healthy, meaning they can comfortably cover their debt obligations. Also, their interest service coverage ratio is 6.71, so they've got a good cushion for interest payments.
Those coverage ratios indicate that they have a good buffer for their debt. And you mentioned their operating margin is around 60%. That's quite high, right?
Absolutely. It's at 62%, which shows they're pretty efficient at what they do. Their net profit margin is also solid at 36%, highlighting profitability after expenses.
High profitability margins with decent debt coverage ratios. It sounds like a company that's in pretty decent shape. Let's shift gears a bit. Did the report touch upon any trends or comparisons with competitors?
Well, the report states that their all India cargo market share grew to 27.2%, up from 26.5% in FY24. And their container market share increased to 45.2%, up from 44.2%, which implies they're grabbing a bigger slice of the pie.
So they're not only growing, but they're also increasing their market dominance. That's important. Any mention of comparisons with industry benchmark?
While the report doesn't give detailed comparisons, it does highlight that they're outperforming the industry's growth rate in terms of cargo volumes. It's like their engines are firing on all cylinders.
That's a useful point. It's one thing to grow, but outperforming industry averages is a big deal and shows they're doing something right. Now, what about the future? What's their outlook based on the analysis?
Well, based on the current performance, and they've even revised their FY25 EBITDA guidance upwards to rupees 18,800 to 18,900 crores.
So they're confident about their future. It looks like they're riding a wave of positive momentum with good growth and efficiency. Any potential catalysts or risks?
They have launched a new trucking management solution, a technology platform. They've also completed some significant acquisitions, which will likely help them scale up their operations.
Those seem to be the drivers for growth, but what about risks?
Well, the report does mention some ongoing legal and regulatory issues, a few show cause notices by the SEBI and some matters with US authorities regarding one of their directors. But the management maintains that these issues aren't material.
So they have some minor legal issues to deal with, but it doesn't seem to be materially impacting them as of now. It's always prudent to keep an eye on those. I always say, disclaimer, we advise investors to check with certified experts before taking any investment decisions.
Absolutely. It is critical to have a holistic perspective and do your due diligence. But overall, based on this report, Adani Ports seems to be on a strong trajectory.
Right. So if we are wrapping this up, what's your concise conclusion for the investors? What are the key takeaways?
Well, Adani Ports seems to be a growing company with a focus on becoming an integrated transport utility. They're increasing their revenue, profit, and market share and managing debt efficiently.
So growth, efficiency, and market share gains seem to be the main themes here. It seems they are really putting in efforts to become a comprehensive logistics solution provider.
Exactly. And with their focus on using technology and scaling up operations with acquisitions, they are positioning themselves for sustained growth, I guess.
Okay, that's a pretty thorough assessment. It appears that Adani Ports is not just a port company, but a growing and profitable integrated logistics player. Definitely a lot to think about.
Yeah, it's been a busy quarter for them. I mean, they even got an award as being amongst the top 10 most sustainable global companies in the transportation sector.
That's really great. It's good to see companies focusing on that aspect. Well, thanks for breaking that down. Very informative as always.
You're very welcome. And before we sign off, be sure to hit that like button, share with your friends, and subscribe to our YouTube channel for more insights like this. So what should we dive into next week?
That's a good question. I have something interesting that I've been researching on. Let's leave the listeners with that as a teaser. Till next week.
Sounds like a plan. See you next time.